Um, Aloha and happy Merry Monarch Week to you all. Welcome to our today's presentation, a lunch and learn on investments and cryptocurrency, organized by our Chamber Young Professional Program team. We're happy to announce that we are transitioning from our all virtual events to in-person social events starting next month. So be on the lookout for our emails, keep tabs on us via our website events page for upcoming events like our fun business after hours events. Most of our meetings, as far as our committee meetings, will continue to be held virtually, but we want to get out and about and start seeing friendly faces again. So be on the lookout for those. And keeping with the varying comfort levels of our members relating to COVID, mask wearing will be optional, or as we say, masks will be admired, but not required. So please join us. We'll also be instituting a color dot system on everyone's name tags when they register. So the color will indicate the level of physical contact you're comfortable with. Red, meaning waves or shakas only. Yellow, fist bumps okay. And green, hugs, handshakes, everything else in between is okay too. Okay, so hopefully we'll see you all at our upcoming event, at an upcoming event starting next month. We are very fortunate to have a team of knowledgeable financial advisors from Edward Jones today, Tara Roulette, Zachary DeBosch, and the Obi-Wan of financial advisors, Keith Merrick. And before we go into today's presentation, we'd like to go around the Zoom room and give you all a chance to introduce yourselves. Really short, just your name, the business or organization you're affiliated with, and if you want to share briefly about what you do. Okay, so I'm going to start off at the top. Let's start off with Dennis, and then followed by Jace.
Hi, everybody. Good afternoon. My name is Dennis Lin. I work for HPM Building Supply as their manager for the prefabricated homes here. And I am also the co-chair of the Young Professionals Program.
Hi, my name is Jace Takeo of Eclipse Effect Events.
Wow, that was short and sweet.
That was fast. Yeah, I should have said something more.
Let's see, Neslin, and let's see, followed by Lorraine.
Hi, I'm Neslin Yamashiro. I am a CPA at Taketa Iwatahara and Associates. A bunch of our staff is on the Zoom call, so you'll be hearing from them too.
Good afternoon, Lorraine Davis with the YWCA of Hawaii Island. I'm the Chief Operating Officer, and I'm also Miles' neighbor.
Yeah, we got good neighbors. Let's see, let's go to Amy, followed by Glenn.
Hi, I'm Amy. I work at Taketa Iwatahara with Ness and primarily work in tax.
Aloha, everybody. My name is Glenn Kagamira, and I'm retired, happily enjoying life and interested in investments. Thank you.
Thanks, Glenn. Our Hawaii Community Foundation Dream Team, Malu and Chelsea.
Aloha, I'm Malu Divas, one of three of our Hawaii Community Foundation Hawaii Island team. I'm a philanthropy officer located in East Hawaii.
Hi everyone, I'm Chelsea Chow and I'm also a philanthropy officer at Hawaii Community Foundation. And I work with Malu and also Diane, we used to have a Waimea office, but I don't know if you guys know, we only have the Hilo office now. So thanks for putting this on.
Okay, let's go to Larry and followed by Tracy.
Aloha, everybody. My name is Larry Lau with American Savings Bank. I've been doing the home loans over here for the last 5 years. And previously, I was actually a YP seminar host. I think I did the first one, if I'm not mistaken, for introducing home loans to the group.
Hi, I'm Tracy. I'm with also Takeda Warahara, and nice to meet everybody.
Thank you. Thanks for being here, Tracy. Let's see. Let's have Juvette and Amber.
Hi, I'm Juvette Hawaii. I also work at Takeda Iwatahara, and I'm in the tax department as well.
Hi, I'm Amber and I work at Takeda Watahara and I'm also in the tax department.
Ness, you weren't kidding, yeah? Everybody's here.
Yeah. So
Cool.
Amber and Javez sitting behind Tracy.
Let's see.
And Amy's sitting behind me.
Great. Let's see. Ashley and Yvonne.
Hi, everyone. I'm Ashley Yamamoto. I'm the marketing coordinator at HPM Building Supply. Thanks.
Yvonne, you there?
She doesn't have her mic set up.
Oh, okay.
But she says hello to everybody.
Okay. Thank you for being here. Let's see. Let's go to Gina and followed by Noelani.
Good afternoon, everybody. My name is Gina Tanoy. Apparently, I'm going to apply for a job at Takeda Iwatahara and Associates. No, I am the company manager for Allstate Insurance, Nicole Kai Insurance Professionals. And I am grateful that you guys let me be in the young group because I'm not in the young group anymore, and looking forward to learning about cryptocurrencies so that I can retire like Glenn and stop working.
Hello, everyone. And I appreciate being here. And good to see you again, Miles. You're always such a funny guy. I always enjoy laughing along with you. So thank you for the opportunity for me to learn today. Aloha.
Thanks for calling in from Volcano, Noelani. Hope the weather's nice up there like it is downtown today. So, and Gina, no worry, they don't check IDs.
Okay,
Just let me
sweet.
come.
You look young.
Oh, thanks. I was saying I got to get one shirt that says chaperone on the over the pocket. Okay, our last three, we have Dana, followed by Kapono and Tiana.
Hi, everybody. I'm Dana. I work at HPM Building Supply with Dennis and Ashley, and I'm the marketing supervisor here.
I think Capono's having some mic issues, so maybe
yeah.
skip over to Tiana. And then I
Thank
saw
you.
Jasmine come in.
Yeah, Tiana, how about you? And then we'll follow with Jasmine.
Okay, hi everyone. My name is Tiana Hirota. I'm program manager at Hawaii Community College's Advanced. We are the non-credit arm of the college. So my title is basically a fancy way of saying I am a program coordinator. But we work with a lot of community members voc rehab counselors to coordinate specialized courses for clients and employees to upskill, reskill. We used to do a lot of personal enrichment courses, not so much anymore. But that's the gist of what I do and what we do in our department.
Great, thanks, Tiana. Oh, Jasmine. Oh, Jasmine, you shifted to the middle of my screen.
Priorities. Hi guys, I'm Jasmine Tamanaha, Hawaiian Airlines sales executive, primarily responsible for corporate business travel here within the islands and community outreach with the business community. Thanks for the great event today.
Thanks, Jazz. Kapono, if you're able to say a few words.
Sure, you're not supposed to come back to me. When I change my name to Reconnecting, you're supposed to just skip over me so I don't have to introduce myself. I'm Kapono, Kapono Pa. I am a real estate broker in charge at Salvio Realty in Pahoa.
Okay, I think we got everybody. Thanks, Kapono. Before I bring on Dennis, who'll be introducing our presenters, we'd like to ask all of you to, if you could remain on mute, but keep your video on if possible. It's easier for our presenters to speak with live people. And we don't mind you eating lunch. It's cool. Okay, so Dennis, take it away.
Thank you, Miles, and thank you everybody for joining today's Young Professionals Investments and Cryptocurrency presentation brought to you by Edward Jones. I want to give a brief introduction to what the Young Professionals do here at the Chamber of Commerce. We are a group within the Chamber between the ages of 21 to 39 who are really starting off in their careers or maybe midway in their careers and looking to get some professional and personal development, as well as some social networking, right? Meeting new people within their industries, learning new things, making connections between, hey, you have CPAs and insurance people, you have real estate, you have financial advisors on this call. So, a lot of connections to be made. Some of the events that the Young Professionals have done in the past, we've done presentations by the Lieutenant Governor, Department of Labor and Industrial Relations. We've done social events at Cronies, HPM. We do outside events as well, such as do some hiking. We just had a climbing event in an indoor climbing facility. But we try to do events every month so that everybody has something to look forward to. Some of the events like today's event is free of charge as well as open to the public. Or to the chamber and the public if we so allow. But we encourage everybody that has employees who fit within our group to join our events, join the committee, plan for more events. And something to look forward to in the future is that the Young Professionals will be holding the Chamber's first career fair, which will be June 3rd and June 4th. More details will be coming via eBlast for registration for those of you who are looking to participate in having a booth at the career fair. And we are planning another Young Professionals recognition program this year. So we look forward to having that in person, which we will recognize the Young Professional of the Year. With that, I'll pass it on to Keith, Zachary, and Tara. Thank you, everybody.
Perfect. Thank you so much, Dennis. And would like to say thank you so much for the inclusion in this amazing group. I'm so glad you're not checking IDs. And so I appreciate it. Zach, Keith, and I all work at Edward Jones, and we are happy to tell you more. But I know you guys are all here in regards to investing. It's top of mind, especially with tax season. And there's some different things to consider. And so what we're going to go through is essentially the foundations of investing, things to consider in your own investment portfolio, investing basics, market opportunities, and then ending with crypto and any questions that you may have. Ultimately, we are all in Hilo. We'd love to meet with you face-to-face or Zoom, especially if you have any personal questions regarding your personal portfolio. So first of all, I just wanted to go through a couple of things. And at the end, I would love to hear your feedback. What did you enjoy about this? Do you have any certain questions? So if you go to edwardjones.com, find myself, Tara Roulette, just send me a quick message. I always appreciate that feedback. So the first thing to kind of think about in regards to investing is, what is your personal need? What type of accounts do you need? I know, or as I was listening, there are some small business owners on this call and individuals, and often an individual and a small business owner may have different concerns or considerations. We work with all of them. We work with each of you to make something that's unique in your personal portfolio. So feel free to let us know. As you know, there are individual retirement accounts, traditional and Roth, and many of the CPAs can say that they have different considerations for your personal tax strategy. That's something we can go over as well. Now, what we do at Edward Jones is we have an established 5-step process. This process keeps you guys first and foremost in centering your financial needs. We just talk about, where are you today, where you want to be, how are you going to get there, and then what does it look like in expectations and working together, partnering together for the rest of your journey into retirement and beyond. So that's something we go through as well. Now, Edward Jones, we're super conservative and we are tried and true, meaning we're going to look for the investments that are going to give you quality long-term diversification, which we believe is the secret to success. And so what some of the things that we look for are, what's your comfort with risk? So when we talk about how much you enjoy that investment roller coaster, do you like being in the front car, the back car, the middle of the cars, or not on the roller coaster at all? And so we have a process to help you identify this, and we build a portfolio strategy according to it. Another question you want to ask yourself is, how long until I need these funds? Am I in my 20s and I don't plan on retiring for over 40 years? Well, then that's one portfolio. But what if I'm at 45 and I'm looking to retire in the next 5 years because you're lucky ducky and you planned well? That's a completely different portfolio. So those are some things to take into consideration. And what we do is then we build a tailored portfolio for you based on what we call the portfolio objective. And so I'm going to go ahead and share this with you. This is one, let's say that you had some time in the market, your risk was high and you were looking to maximize on some returns. Perhaps we would go with what we call a growth focused portfolio. And this is how it's being built. So I like to refer to things very easily. And so I call it the gas and the brake. Fixed income investments, if you put 100% of your energy on the brake while you're driving a car, it's going to be a super smooth ride, but you're not going to go anywhere. On the flip side, equity investments, I often call the gas. And when you put 100% of your energy on the gas, you're going to get somewhere really quick, but ultimately you may feel out of control and you're probably going to feel every bump in the road. And so what I work with my clients to do is find that sweet spot. How do we get to, as quickly as we can, your destination, but still have you feel in control and be comfortable with the amount of bumps that we have in the road? And so what we do then is we look at this portfolio objective. This is fixed income, including cash that we have in your account, and we build it accordingly. So we have bonds and CDs, which are very fancy IOUs. And then we move up to the equity investments, which is like the gas in your car. We have different categories, growth and income. They are ones that our companies are sharing their profits with you as a shareholder. And so this is like Pfizer, and they are sharing their profits. So that is the growth and income space. The next category is growth. These are companies like Netflix or like Amazon. So when they came on the scene, they were selling textbooks for about $100 a share. Fast forward to now, they're selling it for about $2,000 a share. They haven't shared any profits along the way, but the money that you've made is when you bought low and you sold high. And then the next category is aggressive. So Edward Jones, we're super conservative, and that's one that I know is top of mind for you guys, because we would actually put some of the market opportunities that we see in this category, electric vehicles potentially, a cryptocurrency might fall into this category. And so Zach is going to go ahead and go over that as well. Now, some things that we'll talk about if you work with a financial advisor are mutual funds, ETFs, and stocks. Mutual funds are like swimming pools. Instead of kiddos bopping around, they're going to have individual companies like Netflix, Amazon, Google. And it's going to have like a swimming pool, it's going to have those lifeguards. They're fund managers who are making sure that everything is going as it should in the pool. Let's say Tesla pops up, runs around the edge of the pool, and then takes a nosedive into the shallow end. That fund manager is going to actively manage that fund and take Tesla out and maybe put in GM, who is being more calm and cool and doing what they expect it to do. So that is a mutual fund, is actively managed. And then the next one is ETFs. These are exchange traded funds. And so they're a little bit different. They're more passively managed, but think about a real estate mogul going in and purchasing just a block. They buy downtown Hilo block, and in it they have residential homes. They may have a hospital, they have businesses, maybe they have a couple of fixer-uppers. And so they cannot actively bring in and put out what's in this fund because it's defined by the area of the block, but it is diversified and it has many different options in it. Now, because they're not actively moving things in and out, then it's going to be considered a passive management, which could potentially affect your taxes. The last thing is stocks. Stocks are sexy. People like to say, I own this stock, I own that stock, but what you're really doing is putting all of your eggs in that basket. And so when it comes to your personal portfolio, we definitely want to talk about the differences, what makes sense for you, and what ultimately will get you to your goal. And so I don't want to take up too much time. And so I know you guys all came here to talk about market opportunities and crypto. So Zach, why don't you go ahead and take it away?
Sure. All right, hi everyone. Zach DeBush, I drew the short straw here. So we'll discuss current market opportunities, how our investment strategy applies to current market opportunities, best way to harvest positive returns. I've been advisor with Edward Jones since January last year. Lived in Hawaii about 5 years. I've seen everyone here a couple times. So thank you very much for having us here. It really is a pleasure to be here. Some of this stuff, I want to just give a general overview. I'm trying to make it as clear as possible. Some of it can be a little convoluted, but yeah, let's just carry on. Let me go ahead and share my screen here. Oh, whoops. That's not mine. Wait, is that mine? Yeah, that's mine. Hold on, sorry. All right, so how do anyone know how to get the bar out of the way here so I can see my tabs? Oh, this is not something I anticipated. Oh, there we go. Never mind, I did it. All right, so carrying on. This is where we left off. She had a growth focus. This is an all equity focus. It's just another portfolio objective. So again, we take your risk tolerance, take your time horizon. Those three things combined gives a general methodology that we can use to invest. And it's going to be broken down into these categories. So this is, again, an all equity focus. So there's no income here, there's no cash. And again, we have these broken down into percentages: US large cap, international large cap, growth investments such as US small, US mid, international small and mid, and aggressive investments like emerging markets. Least amount of risk up here as far as investments in stock are concerned. Again, these are companies like Amazon, Google, Facebook, Chevron, McDonald's. A little more risk here if there's difficulty with short-term, short-term necessity for capital. If there's credit crunch, something like in 2008, US small and mid may have a little more struggle than something like US large cap stuff. And then emerging markets is going to have the highest amount of risk here, the most amount of fluctuation, also really good potential for return. But you see the percentages are based in the amount of risk that you're going to be taking with each of these investments. So these percentages are specified in what we have, or what we call it, what it is called strategic asset allocation guidance. Strategic asset allocation guidance. So this identifies percentages based upon historical trends that we believe are going to perform very well over the next 10 years. So we're confident that if you come in and you say, hey, I'm 25 years old, I have very high risk tolerance. I'm looking for returns here. I have 30, 40 years until retirement. And I want to go with the all equity portfolio. This is what you'd be looking at. And so we would create a portfolio for you based upon this strategic asset allocation guidance. Essentially, this is something that we're confident would do well over 10 years. Now, does this mean that we just create a portfolio and just leave it on for 10 years? No, of course not. This is our starting position. We also have year-to-year trends. So we want to understand what the current market opportunities are, what the current economic environment is, and then we can make small alterations to this. So we can say, hey, over the course of this year, we think growth investments, particularly US mid-caps, going to do very well based upon the prices that we saw last year and based upon the current market conditions that we're seeing this year. So we actually want to go a little overweight in US mid-caps this year. Maybe in order to account for that increase in mid-caps, maybe something that we saw last year, maybe aggressive investments we don't see the potential to form as well. So we'll decrease our allocation here in aggressive investments. And then just year after year, we revisit these, we take a look at what current trends we can hook into, and then we can make small rebalances here. So this is our opportunistic asset allocation guidance. So we saw strategic, which is that 10-year, and this is 1 to 3 year. So this is for this year. So what we're saying is neutral here means we want to be on our numbers. So we want to be on our numbers for US large cap, on our numbers for international large cap, on our numbers for mid cap, on our numbers, we want to be under our numbers for US small. So what that means is that we see a little extra risk in US small caps over the course of this year. We do want to have some exposure, but we're going to be balancing underweight relative to our 10-year approach. International small and mid, we want to be on our numbers. Emerging markets, we actually see really good potential. So we're going a little overweight in emerging markets over the course of this year. So that's how we alter that 10-year outlook. Now, what we just looked at is all equity focus. If you do have fixed income, we want to be a little overweight in US investment grade bonds. On our numbers otherwise, except for international bonds, we want to be a little underweight. So essentially what this does is if you do have fixed income in your portfolio, this will kind of increase the shocks on our economic vehicle that we're using to ride the market, make our road a little more smooth, a little less bumpy. But if you're looking for full exposure to equities, both United States and international, then this is what you're going to see as an alteration to the 10-year outlook. So, of course, if we see, over the course of this next year, if we thought perhaps we were leading to a recession, I doubt very much we'd be looking at emerging markets, right? So last year, emerging markets was the worst performer on this list. It was the only equity to have a negative return last year. So the prices are fantastic this year. Now, good prices is really, that's what you want. You want to buy something at a good price. You want to see that stock go up in value and then potentially sell it. But in the very least, you want to buy it at a good price. So we see good prices in emerging markets. But if we saw difficulty, we saw storm clouds on the horizon as far as the economy, as far as the market is concerned, then I doubt very much we'd be saying that we want to be overweight in emerging markets. So what exactly are those current market conditions that are allowing us to say that we want to be overweight in this category? So this is our quarterly market outlook. So obviously, top of mind, we have geopolitical tensions between Russia and Ukraine. Now, we'll be discussing that in a financial context. Obviously, it is a human calamity. But we want to understand how this affects portfolios financially. Also, inflation is top of mind, and COVID is top of mind. Now, all these things are fairly interconnected. So firstly, we can start, if we want to understand the fundamentals of the market and of the economy, we can start with where are we in the economic cycle. So economy is cyclical. We have expansive periods that are exemplified by rising economic growth, increasing gross domestic product. So just the goods that are produced in the country. 2.5% to 3% we see growth potential in 2022. That is indicative of an economic expansion. And we're midway through it. This is indicative of a healthy economy. So when we say like market or economic fundamentals, what we're referring to is where are we in the economic phase, and do we see expansion or do we see contraction? Because what you'll see in the economic cycle is an expansive period. You see a peak, and then you see a contraction period on the other side, where you see a decrease in gross domestic product, decrease in production. And there are different investments, of course, that perform well in these different environments. We see a continuing growing economy over the course of this year. Also, like corporate earnings, very good. And the consumer is in a good position. So 2.5 trillion versus pre-pandemic levels in savings. So these are excessive savings. So there's a good amount of money in the pockets of general folks in the United States. What this means is that we'll be able to absorb the inflation that we're currently seeing. Now, do we want to? No, of course not. And like, do we all complain about it? Like, yes, absolutely. But what this means is that we can complain about it for a certain period of time and deal with it because there's a good amount of savings in our pockets to deal with this. Now, this is a bit of a double-edged sword. Why is there a good amount of savings? There has been a lot of economic stimulus over the last 2 years in order to deal with COVID. So we've seen a lot of money come into the market or come into the economy over the last couple of years as economic stimulus. COVID has also stopped or really limited the amount of goods that are coming to market. So we're seeing a lot of supply chain issues. This has resulted in a lot of dollars chasing too few goods, and that causes prices to rise. That is what inflation specifically is. So that is currently being exacerbated by geopolitical tensions between Russia and Ukraine. So really, we see that and hope for that to be a more of a near-term issue. That hopefully they'll find peaceful resolution, hopefully over the next couple of months. But it will extend our inflation woes because that's causing an obvious, painful increase in energy prices, and we've seen that as a spike in pump. So, but overall, we're in a good position. The economy is in a good position for continued growth over the course of this year. We are in an inflationary environment. This is why we'll see rates on the rise. So, the Federal Reserve controls short-term interest rates. Money is produced in our economy when commercial banks take reserve funds from the Federal Reserve at some interest rate, and then they use that as a basis for producing loans to the public. So when loans are produced and given to the fanned out to the public, money is created. So if it's more difficult for commercial banks to take money from the Federal Reserve because it costs them more to do that, then there are less loans made by banking institutions, and therefore there's less money in the economy. So when you see rates on the rise, when you see rising interest rates, just think it's going to pull money out of the economy. And then otherwise, the Fed is also reducing its balance sheet assets. What that means is that the Federal Reserve is going to sell treasury bills. So when the Federal Reserve buys treasury bills, it increases its balance sheet, and that also fans money out to the economy. So when the Federal Reserve sells treasury bills, it's going to pull money out of the economy. So what the Federal Reserve is doing, because there's too many dollars chasing too few goods, is it's decreasing the amount of dollars in circulation. That combined with hopefully COVID continuing to wane. It's either a combination of COVID continuing to wane or us just being less concerned with it. I think it's a combination of the two. Hopefully we'll see with unemployment numbers being very good, in a tight labor market, meaning people can kind of pop around in jobs if they need to in order to continue to make money to feed their families. We'll see supplies being brought to market, goods being brought to market as dollars are being brought down, and hopefully inflation being brought under control. General idea was hopefully 3 to 4% at the end of the year. I think Russia-Ukraine issues are going to prolong that a little bit longer. We're going to have inflation be an issue for a little bit longer. So hopefully early next year into mid next year, hopefully we should see inflation being brought under control. But that is what's called a soft landing. Soft landing is the Federal Reserve raising interest rates without leading us into a recession. So our basal assumption as of now is that we will not be led into a recession. We're going to continue economic expansion, and we're going to continue a bull market this year for investments. It's just going to have a different complexion, because what this does when interest rates rise, it resets the interest rate environment in the market. So what that means is that the current bonds that are in circulation, they're going to lose value. There's an inverse relationship between interest rates and bond prices. So the current bonds that exist are going to lose value when interest rates rise. Now, the reason for that is that, let's say we're at a 2% interest rate environment. I mean, we're not, but let's just say we are right now. If I bought a bond from a company at it's paying me 2% a year to hold it. If the next bonds that are going to be issued are going to be at 3%, then why would I hold on to a 2% bond? I'll sell that 2% bond, I'll buy a 3% bond because I'm being paid 3% now. So the current bonds that are in existence are going to lose value because there's better bonds that are in existence because we're in a new interest rate environment. Now, what this does, it also puts a damper on speculative investments, bubbling investments. It means people really invest based upon fundamentals that exist in the market. So people are really looking very specifically to invest with their dollars where there is fundamental value there. Whereas at the end of 2021, we saw massive growth in growth stocks like Amazon and Facebook. And essentially people were buying them because they were continuing to increase in value. They weren't necessarily buying them because of the relationship to the fundamentals that we're using to come up with a fair market value for the stock. So that's what people are going to be doing now. We're also going to see fixed income take a whack. But fixed income taking a hit over the next year, it doesn't fluctuate a great deal. You know, we can see 3-5%. I'd say probably, I think we're seeing about 5, I think maybe 6% down in fixed income currently. Whereas with equity, you can see massive fluctuations. You can see 20%. You know. So generally speaking, we still see fixed income as a good holding, but we're going to see a very volatile year. So looking at our opportunistic asset allocation guidance, if you do have fixed income, even though they'll take a bit of a hit, we do see an overweighting in U.S. investment grade bonds because they'll be able to absorb these bumps and bruises that we're going to see. We're going to see big fluctuations here in equity. But again, we see the potential for a continuation of bull market. So we do want to invest accordingly, primarily within emerging markets. So that is our strategic asset allocation guidance forms a baseline for how we're going to invest. And that's dependent upon the amount of risk you want to take and the time horizon within which you'll be invested. You know, so what we want to do is we want to find a carrot that's going to incentivize you to stay in the market when the market's here. So we want to say, hey, how much risk did you want to take? Is 37% potential growth enough for you to stay in the market, seeing a potential downside of 24%? And if you say, yeah, we say, right on, let's do it. You're most likely not going to see this year after year, but you can potentially see this. So we want to find this because we want to put you in an investment vehicle that's going to allow you to ride the market and be there when the market returns. Generally speaking, 3 years to 1 up versus down. So the market returns positive more than it is down. What we want to avoid is having a misunderstanding of the amount of risk that you're taking. We want to make sure that this is hammered in, because if you're taking too much risk or you don't have an understanding of the risk that you're taking, because myself I have not relayed that information to you properly, then you can get spooked when you see this. And this is pretty scary. So of course, if you're not expecting it, you can definitely get spooked with this. And you give me a call, you want to sell. And the idea is that you want to get back in when the market's returning positive, but nobody knows when that's going to occur. We really don't. We want to avoid timing the market. We want to hook into long-term yearly trends with our opportunistic through thoughtful rebalancing, but we're not trying to make quick knee-jerk reactions here. So finding this is of primary importance in you having success, and that is based upon you and your financial advisor giving you a proper indication of what your expectations can be with your investment style. So looking at this opportunistic asset allocation guidance, that's a lot of words, and forgive me, but where does crypto fit in here? Where would you think? I would imagine you probably think it fits in here, emerging markets, because certainly it is emerging. We don't know where it's going to land as of yet. And it can either be classified perhaps as an emerging market, or it can also be classified as a fringe commodity. We don't have any room for it, or we don't have a position for it as of now, and we'll see why. So for us, fitting crypto into this, it does not fit as of now. So let's dive in and see, let's take a look at our opinion piece on it and see why exactly we have that. I'll see if I can find it. There it is. Okay. So, Bitcoin, cryptocurrencies, and blockchain. Overall, I mean, just what is it? It's such an interesting. I find it fascinating. So what it is it's digital currency, and that digital currency relies on something called blockchain technology. So blockchain technology what that essentially means is that there's a network of computers that are running a math problem. They're trying to solve a math problem, a math puzzle. That's how you can think. That's how we can think of it. It's an energy intensive process. It requires a lot of electricity to run this. Over time, the problem is solved as long as all of the computers in the network agree. Then there's a block created. That block is a digital footprint that represents a certain number of coins in whatever it is that's being produced. So if a block is created at the point that this network solves this problem, then a certain amount of Bitcoins are produced. Now, as soon as that block is created, this network of computers goes ahead and continues to run another version of this math problem. However, this time it's a little more complex. So it's going to take a little bit longer for it to solve. Solves it again, all the computers agree, another block is created, represents another number of whatever coin it is that's being produced, connect that to the previous block, now you have a blockchain. As this continues and continues and continues and continues, the blockchain lengthens. Eventually, this process will become so labor intensive that it will no longer viably produce any more coins. And the reason for that is that the mathematical problem that it's attempting to solve is sufficiently complex to where you just can't solve it any longer. So you'd be foolish to attempt to mine these. And that's what this is called, mining, Bitcoin mining or crypto mining. So when you hear mining, just think of all these computers that are attempting to run this program to solve this problem. So like with Bitcoin, for instance, 2035 is looking like when Bitcoin is going to no longer be produced. So these are finite, very interesting finite entities. So very volatile. It's going to continue to be extremely volatile for the foreseeable future. So highly speculative, most likely not for majority of people. Now, it has been the best performing asset of the last 10 years. If you would have, I saw a stat, if you would have invested, $100 in Bitcoin in 2009, you'd be a multi-millionaire. And I mean, that would have been nice. Actually, a friend of mine actually invested in Bitcoin back in 2009, and he called me up recently asking if I remembered where he put his Bitcoin wallet, and I was like, oh no, I don't remember. So it has been a very, very, very well performing asset. But what exactly is it? What position does it occupy? Again, people are using it as an inflation hedge. So the market's pricing it in as an inflation hedge. It does have a fixed supply, 21 million units. Again, that'll stop around 2035. Now, typically, inflation hedges are things that are finite or things that can be seen as not as well. Things that maintain their value have more intrinsic value. This doesn't really have any intrinsic value, so it's interesting that it can be an inflation hedge, but that's what people are using it for. Also, PayPal, Venmo are actually using it as its currency, in its currency capacity. So it really was meant to be a currency. So originally, it's meant to enable peer-to-peer transactions without any oversight, without any regulation, and without an intermediary. So it's just kind of a pure form of digital trading. So PayPal is using it in its allowing to use it in its actual currency capacity. This is Venmo, Square. However, just keep in mind that really in order to, like if I sell something on PayPal, I get Bitcoin for it. In order for me to really harvest the value of what I sold, I still have to exchange that into Federal Reserve notes, which is again kind of an issue with Bitcoin and crypto as of now. And otherwise, Tesla, MicroStrategy, these companies making large purchases of Bitcoin, so like large block purchases of a commodity or of a stock, it drives the price up. So other folks kind of follow along after that, because if Elon Musk is buying a lot of Tesla, or forgive me, buying a lot of Bitcoin, then generally people say, well, I think it's probably a good investment, I'm gonna buy it too. Also, Tesla announced that he would accept Bitcoin for payment, or Musk announced he would accept Bitcoin for payment. But then, if you recall, he kind of wavered on that a little bit, and we just saw massive fluctuations in value of Bitcoin. And it really is kind of whimsical. And that is our primary issue with Bitcoin and cryptocurrency, is we have no idea where it's going to land. It's hugely speculative. So 2017, 1,200% rise in Bitcoin. $19,000. So 1,200% increase. That's amazing. The following year, it dropped 84%. So if you invested when Bitcoin was, I don't know, $1, you would have made a huge amount of money. If it is now valued at $19,000, of course, depending on how much you bought. People in this position are like, well, I wish I would have bought more, but how did you have any idea when you bought it? But if you bought it at 19,000, expecting it's just going to continue to go up, you have no way to analyze what its real value is because it doesn't really have any fundamentals to study. Then you lose, in that same year, you're down at $3,200. You'd be really regretting your investment. And this is, this here is the reason that we want to see where Bitcoin lands in the future because it's so massively speculative. Generally speaking, like commodities, you're going to see large amounts of fluctuation. So if you're investing in a specific commodity, then, we don't recommend having anything more than really 3% of exposure to that because you're going to see large fluctuations in value just in general. This is massive fluctuation even compared to that. So we're not in a position to put our investors in an area where they can see such massive amounts of fluctuation. We can't really diversify this risk out. So again, this fluctuation is why we don't see it on our horizon currently. It's very similar to other bubbles that we've seen. It actually dwarfs them. .com bubble in '99 or using U.S. housing market bubble in 2008. 1,200% and then 84% down the next year. This massive fluctuation. And the risk and the issues with that, or the reason that exists, is because there's no underlying fundamentals. So as a firm, we utilize fundamental analysis in order to understand a proper value of something. So if Amazon is issuing stock, then we take a look and see what that price is. We don't even invest in IPOs because typically IPOs are difficult to judge what the actual value is. Because the stock is brand new and typically it has a spurt right off the bat and then it kind of dives off and then it kind of stabilizes. So we really want stability. We want to make sure that when we're investing in a way that we can predict. And then we want to make measured, we want to take measured risks that are educated. And over the course of the last 100 years, we've been pretty successful with that. And the reason is because we don't really engage this stuff. We see where it lands first. And what we do is, so we'll look at Amazon's cash flows, profits, we'll look at the product they produce, we'll look at how competitive they are, their managerial structure, how much debt they have. These are all fundamentals that are freely available to study. And then through that, we can gain an understanding of what a fair market value of that price is, of that stock is. And then we issue a buy opinion on it, which means we believe it's going to outperform its competitors over the next 3 to 5 years. We issue a hold on it, which means that we believe it's going to perform generally in line with its competitors. But if you're going to buy, perhaps there's other things in its category that we can buy that would perform better. But if you have it already, let's just hold it. Or we issue a sell on it, which means that we believe that it's overvalued. It's going to lose value in the future, and we should move it. But again, Bitcoin doesn't have any of these. So that's the difficulty is we don't want to take exorbitant risks with our clients' money. We want to take measured risks in a way that's going to allow them to achieve their goals, because that's what this is all about, is allowing you to achieve your goals. And we want to get you to that position. So this is too bumpy of a ride. It's a little too scary. It is unique though, and I find it very interesting. And again, it is a currency. So, it's meant to be used in that fashion. And what you're seeing is that all these other crypto endeavors are popping up. And what they're doing is they're creating their own metaverses that their currency will be the currency of, that are used in that metaverse. So we know that Facebook is launching a metaverse. It's changed its title tag actually to Meta. And it's just a virtual reality within which you can do all the things that you wish to do. So perhaps in the future, what we'll do is, instead of having a Zoom meeting where we're seeing each other virtually on a screen, we'll have headsets on and we'll be sitting in a room, and maybe that room will be very my light turned off. Maybe that room will be very very similar to our actual reality. And at some point, I think that's probably what we'll be experiencing. But because the currency has no real use right now, because it's competing with the Federal Reserve note, which is very difficult to do, companies are actually producing their own metaverses, and then they're producing a coin with Bitcoin, forgive me, blockchain technology that will actually, that's the currency that you'll trade in this metaverse. So I don't know, maybe we'll meet up in the future. We'll be sitting in a room. We'll all have our avatars. And, you know, I want to go get a, I don't know, a virtual soda, or I want to find something that I can, you know, I don't know, bring and show you to make you think that I'm cooler than I am perhaps. And I'll go get it and I'll spend this virtual coin in order to get it. Anyways, that's a side note. There is some room for it. We don't know where it is. Huge amounts of fluctuation, too much risk for us to take investing in order for us to really believe that we can reach our goals with this. So as of now, we're staying away from it. Very interesting though. And then this is just, am I going over? Sorry.
That's okay. I just want to make sure we have time to answer questions. So
yeah, this is the end of it. So with time, we'll, you know, plenty more here to discuss. We can discuss it in the future. It's just, you know, bulkish Bitcoin and whatnot. But what's next? You know, it does enable peer-to-peer digital payments, which is very good. It allows excellent regulatory record keeping, financial transactions, personal control of online identity because of its encrypted nature. So there is room for it. It does have potential. It's going to cause further innovation or more regulation. Further innovation really means that perhaps Federal Reserve or the United States government is going to create a currency that has all the value of crypto, but it's backed by United States fiat, which would outcompete a company like Bitcoin. And also we'll see heightened regulatory scrutiny. So it's really up in the air right now. A little too much risk for us to invest in, but very interesting. And I've taken a little too much time, I think. So I hope I was able to make that understandable. And I don't know, Keith, if you have any input other than just telling me to be quiet.
Oh, that's good, Zach. I just wanted to get in to answer a few questions. So
sure. Yeah, sorry about
that. So one of the questions that we got from Glenn actually beforehand that I wanted to touch on before getting the ones that are in the chat was Glenn had asked about quantitative easing. So that is a tool that the Federal Reserve uses to help. Well, what they would do is they buy treasury bonds. So they actually buy paper, treasury, and mortgage-backed securities of the US government. And what that does is they're creating demand for those bonds. And because of the demand, that drives the interest rate down, right? So with a lower interest rate, then basically it makes it cheaper for people to borrow money, and thus they can take more money and use that money to buy things, which stimulates the economy. So that's what quantitative easing is. And the reason they use it is because, you know, the Fed can lower the interest rate or the federal funds rate to zero. But on top of that, if they do quantitative easing, they can, again, get more money in the economy and get the economy moving. So what they've stopped doing, or what they're doing, is they've stopped quantitative easing. So what that means is they are not buying the federal bonds as much anymore. So that decreases the demand for the bonds, which means that interest rates and yield have to go up to attract other buyers, right? So when the interest rates go up, then basically people are going to be less likely to borrow money, therefore less likely to spend money, and that's going to reduce inflation, right? And also cools the economy. So that's basically what quantitative easing is. It's just another tool that the Fed uses, and the reason that they're basically slowing it down or stopping it is because they're trying to cool off the economy and get inflation under control a little bit. So hopefully that answers your question, Glenn. I saw a couple other questions. You were asking about cash is king, right? Cash is king if you're ready to buy something right now, but cash is a losing proposition if you have a ton of cash on the sideline and inflation's running at about 6 to 7% a year as it is right now. Your buying power goes down every year, because you can all think about what your parents bought cars for when you were younger, right? My mother bought brand new cars, like a Toyota Tercel, I think for $8 grand. Well, that same car is now what, 20 grand or something, or they can probably actually get 30 for it these days. But yeah, so I mean, cash is king if you're going to buy something immediately, but too much cash, you actually lose value over time. A couple other questions I'll try to answer. You also asked, Dennis, how often you should have your portfolio reviewed or rebalanced. We typically try to do that at least annually, but you know, everybody's different and it depends on how much risk you're taking, right? The more risk you're taking, the closer you got to watch that and make sure you're rebalancing it more often. And then you also asked about how to protect, I guess, your portfolio from inflation or increases in interest rates. That's a harder one, honestly. So my typical answer is the best way to protect yourself from inflation is to own equities, because especially dividend paying stocks, because they can continue to raise their dividend to stay ahead of inflation. Because as Zach talked about, when interest rates go up, bonds do typically go down in value, at least initially. You get paid more over time, but your existing bonds go down. So your defense is a little challenging at this point because the defense is actually going down. So that's that one. But like I say, that's not an easy answer. And then lastly, someone asked about tips. And tips are basically bonds that are tied to inflation. So tips are very popular right now because inflation is fairly high. And so tips basically pay based on what the interest rates are. So in a rising interest rate environment, tips do very well. But when interest rates start going down, they actually start doing pretty poorly. And the answer was, can you lose money in tips? And the answer is yes, you can lose money in tips. And the way you lose money is you buy it when interest rates are higher. And if interest rates start dropping, then that's how you lose money in tips. So hopefully that helps. Other questions, because I kind of jumped in on you, Dennis. Did you want to see if anybody else has any questions?
Yeah, I think one more came in from Capono in the chat. Is the Edward Jones report on Bitcoin cryptocurrencies that Zach was sharing available to view online, or is that strictly a...
Yeah, and I'm sure Zach can email that to Miles and Taylor and they can send it out to the group. So yeah, that's not a problem at all.
Sure. Any other questions from the group? Or any follow-up questions to some of the answers that Keith provided?
You can ask realtors right now. Cash is king when it comes to buying houses.
Yeah, that's the viewpoint that my parents have.
Oh yeah. Yeah, like I say, if it's a short-term need, cash is wonderful. If it's a long-term need, not so good. Yeah.
Well, I really appreciate Keith and your team for presenting today. If anybody on this call has further questions that they want to ask offline, feel free to send them over to them. Or we can send it to Miles and Taylor and we can forward it over to Keith, Zach, and Tara. But at this time, you guys can either stay on the call to talk story or sign off. But thank you very much for attending.
Thanks, Dennis.
Thank you.
Thank you.
Thank you. Bye.